Yeah.
So no movement on the fiscal cliff negotiations, no major economic data. Instead, stock markets focused almost exclusively on the Federal Reserve for the entire trading session. And the major indices were able to jump midday after the central bank's announcement it would continue supporting the economy. The gains didn't last long, though, and here's how we settled at the end of the day. The Dow fell 3 points at the close. The Nasdaq dropped 8.5. The S&P 500 closed essentially unchanged.
For more analysis on that unprecedented Fed decision, we turn now to Mohamed El-Erian. He's CEO of PIMCO. Mohamed, great to see you. So you've had time to think about what the Fed said. What's your take on this unprecedented move? Is this a good thing? Is this a bad thing for the economy and for, the outlook going forward?
So my take is basically what you saw in the market today, which is to combine the words unprecedented, surprising with unchanged markets. How do you do that? The analogy, Susie, is look at a patient who's taking an experimental drug that hasn't been clinically tested. Professional investors like the idea that the Fed is all in. They like the idea that there's some drug out there that can help the economy. So they get excited about that. But at the same time, professional investors realize that we are totally in unfamiliar territory. The operational modalities are complicated. The analytical underpinnings are missing, and it has not worked in the past. So I react as, you know what, this is neither good news nor bad news. This is just a confirmation that the Fed is all in. It doesn't speak to what's going to happen to equity prices on its own, but it does speak to certain things. It speaks to a weaker dollar, probably higher gold prices, and more intraday volatility.
So that begs the question then, what should investors be doing with their money? They know that rates are now really going to be super low for a while. We know the Wall Street saying don't fight the Fed. So where should people put their money right now?
So the most likely scenario is that you get a bit of tranquility and then something breaks. And it breaks in the sense that systems are not built to be run at artificial interest rates, and with the Fed being both a player and a referee in markets. So the most likely outcome is a bit of tranquility and then a higher risk of something breaking. So what we are doing is we are taking down risk. It has been a wonderful time for risk assets. It's time to reduce your risk exposure, and it's time to build a little bit more inflation protection in your portfolios.
So, Mohamed, are you buying treasuries at this time? Would you suggest investors get back into treasuries?
I would say focus particularly on inflation-protected treasuries or TIPS, because part of all this is a message from Ben Bernanke that the employment objective is really important, and they're willing to tolerate higher inflation in order to get to the employment objective.
Let me ask you this. I know that PIMCO has backed away on and off during the last year or two on bonds. Do you still think there's a bond bubble?
So we believe that it depends which bonds you're talking about and which part of the maturity. So let me be specific. U.S. Treasuries. If you're talking about the long maturities, 15, 20, 30 years, we would say be careful. In most scenarios, those come under pressure. If you're talking about the shorter maturities, we think there remains value. Not as much as there used to be, but there's still some value. So 10 years and in is safer. 10 years and beyond is dangerous. If you're going to other bonds, it depends on quality. Investors need to focus on companies or sovereigns with very strong balance sheet, exposed to growth, and positive cash flows, because you're going to need all three things to navigate this more complex environment.
Let me just ask you real quickly before we leave here about the fiscal cliff, because Ben Bernanke talked a lot about that today, and we were just discussing that with Darren about all the risks that go with it. There's been a lot of back and forth with lawmakers and the White House. What is the best possible outcome that you're expecting and hoping for?
So it's different things. So what we hope for is that our politicians come together and agree on a grand bargain that combines the following: medium-term fiscal reform on both the revenue and the expenditure side, a small upfront stimulus, and a set of other policies that help our economy grow. That is what we hope for. That's what should happen. What's likely to happen is a mini bargain at best.
All right, we're going to have to leave it there, Mohamed. I wish we could talk to you more. Hopefully you'll come back to us again. We really appreciate your time. Mohamed El-Erian, CEO and Co-Chief Investment Officer at PIMCO.